So while the median stock in the class of 2019 is up nearly 9% from where its deal was priced, it's actually down 3.3% from its first trade. That's cautionary, people. Of course, there have been some huge winners. Beyond Meat, Shockwave Medical, Zoom Video, Cortexyme, and Revolve Group have all more than doubled from where they came public. Beyond Meat's up 554% at the moment. And because we have accountability here on Mad Money, we want to review how we've done. So let's go over the IPOs that we've covered. There are 13 of them we got to kind of drill down on. First, this whole IPO cycle kicked off in March when Levi Strauss & Company came public. I told you it was too expensive, and I'd only recommend it on pullback to 20. After trading sideways for a few months, wow, Levi's reported a quarter that the market didn't like last night, and the stock got obliterated, down 12% today. It's now under 21. Honestly, even under 20, I'm not even sure if I want to buy it after we heard from management last night. Second, there's the Lyft debacle. The rideshare company came public at the end of March, spiked dramatically at the opening, and then started going right back down. Lyft peaked at $88 on its first day. By mid-May, it had pulled back to $47. And while it's rebounded to $62 right now, well, it's still well off its highs from the day that it came public. I told you Lyft could be a good trade if you got it below 75. But the stock's strength at the opening suckered me into thinking that there was more demand for this thing than there really was. As Churchill might say, not my finest hour. In retrospect, I have a lot of concerns about the sustainability of the business and Lyft's slowing growth. There are better places to put your money. On April 4th, we got Tradeweb Markets. That's an electronic securities marketplace. The stock started strong, and I told you it was still cheap not long after it came public. Good call. Tradeweb has continued to climb higher. It's given us a 31% gain. I still like Tradeweb up here because it's a play on the continued digitization of trading. If you bought this one of my recommendation, I don't know, maybe ring the register on some, but sure they got to let the rest ride because it looks a lot like market access, and that was one of the winners I told you about at the top of the show. Fourth is Pinterest. That's the social media network based on online vision boards. I told you Pinterest was worth buying if you get it in on the deal, but otherwise I said you might want to hold off. Now, this was a little too conservative as the stock racked up some nice early gains. Since then, though, it's been pretty sedate. A couple of months ago, we sat down with Ben Silbermann. He's the excellent CEO, and he told a very good story about how the company reported some earnings, really numbers that weren't as disappointing as Wall Street said, but, you know, it didn't matter. People thought the numbers were ugly. He's rightly in spending and heavily spending for the future, and that's really what went wrong here. I think it's worth owning, although I'd like it a lot more, of course, on a pullback. I have to admit that, boy, oh boy, do they send a lot of emails when you subscribe. Fifth, there's Zoom Video. That's the purveyor of cloud-based video conferencing software, which came public on the same day as Pinterest and ended up becoming one of the hottest deals of the year. This thing priced at $36. I thought it was okay. It opened at 65, though. It continued to roar up to 107 last month. We're finally pulling back to 92 and change as of today. Now, I was very worried about the valuation here from the get-go, which in retrospect was a big mistake. The market was desperate for something like Zoom, turbocharged revenue growth, genuine profitability. Still, Zoom sells for 33 times next year's sales, not earnings. I can't get behind anything that expensive. I'm afraid you'll get hurt. Cisco's got a competing product, which I think could get some traction here. Again, I reiterate, I was wrong about Zoom Video. It's been a rocket. I was too conservative, too bearish, too cautious about the stock of what is a very good company, and I hope they'll come on the show. Same goes for Beyond Meat, which we've talked about a lot. The maker of plant-based hamburgers changed the game when it came public a little over 2 months ago. While the gains here have been spectacular, especially since Beyond Meat reported a blowout quarter in June, the stock's valuation is simply bananas, people. I know I've been too cautious about this one, too, but discipline should always trump conviction in this business, and my discipline tells me that Beyond Meat is a cult stock, a cult stock. That's way, way too hot for us to touch. Plus, my wife says they taste terrible. I like them as long as they're smothered in condiments. Its valuation is impossible to understand, at least until its rival, Impossible Burger, comes public. How about Uber? Another big one that came public with a whimper. After the Lyft debacle, we were worried about Uber, but while the stock initially got hit, it quickly bottomed. Lately, the performance has been pretty decent. This thing's up 21% from its lows. Unlike Lyft, Uber actually reported a solid quarter right out of the gate. I'm warming up to this one again, but I want to see another good quarter before I'm ready to really say, you know what, Uber's for real.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.